We'll go right to the business. So we'll talk about European call option. Uh, the whole point about financial derivatives and options is that these are they're derived from underlying securities, or these are options on underlying securities. So European call option is the most basic example. So you have an option, not an obligation, to purchase an underlying asset, right? You have the option to purchase an underlying asset at a specified time t. We'll call it big T. This is expiration or maturity date for a specified price K. This is called the strike price. So this is specified right now, right? And the question then is, so that's the option that you have. And the big question is, what's the price of this option? What's the correct price of this option? Now, you might think that the price of any option, there are two parties of this, right? You are getting an option by purchasing this. Somebody is selling this to you. So they are writers of the option. So you both have to agree on the right price, right? So as said, demand and supply will determine the price, but there's an elegant theory which tells you what the price ought to be. And really the price, when you purchase something like this, you're taking some risk. So the amount of money you need to hedge that risk is the price of that risk. That's a new insight that the world of finance brings in. That's a new insight that there's no arbitrage principle that we're going back and forth on again and again brings in. So now if you were to search on, I guess now you can use maybe Gemini, that's what I did yesterday. So you get Tata Steel stock prices 158 rupees 30 paisa, option that matures on October 28th, 2025. This should be a fourth Thursday of the, can somebody check for me? Is it fourth Thursday of the month? So it's all 4 Thursdays of a month, or maybe the last Thursday, I'm not sure. Yeah. And the strike price is 160. So what's the price of having this option? So it turns out that the market thinks that the price is 6 rupees 55 paisa right now. So the theory behind how you come up with 6 rupees 55 paisa, and more importantly, theory behind how to hedge such a risk that you take when you're writing an option or when you're buying an option. Right, so those are ideas we'll be discussing. This is a European call option. You can exercise it only on October 28th. Right, on October 28th, you can say, okay, I'm going to exercise my option, give me the stock for this value, this strike price. American options, you could have exercised any time up till October 28th. So they had this early exercise feature. Now, India used to have this American option feature till 2010 or so. And we've gone to European options since then. So India right now, you'll have just European options. And these are equity options because these are equities, stock prices. You could have options on interest rates, just the value of interest rate. I'll talk a little bit about them. You could have options on commodities. Equity options are perhaps the biggest market for that right now is India. They get, in terms of number of contracts, they get traded about 10 times more in India than they do in the US. And it's a vast market, but not in the money amount, just in the number of contracts. Okay, so American option, as I mentioned, an option to purchase an underlying asset at any time up to a specified time t for a specified price k. And so maybe we'll discuss briefly American call options as we go along, but we won't have too much time to talk about this. It brings in a control problem, a mathematical problem on when to exercise. Right, so that's an interesting optimization linker to the problem. All right, let's talk about call option now. So you have option to purchase Tata Steel stock at 160 in October 2025. Option payoff if option is exercised when stock price is rupees 200. Just give me 1 second. Yeah. 200 is going to be, just 40 rupees. If you exercise it, if the stock price is more than 160, you will exercise it and you'll gain something. So this is the picture of the payoff at maturity. So it's maximum of stock price at maturity minus the strike price and 0. So it's 0 till 160 and then it increases linearly. So that's the payoff. And you pay some price to get this option. This price is right here. And hence you make money only if your stock price is beyond some threshold, which accounts for 160, the strike price, and the price you paid. So this is clear to everybody, right? You can see this profile. This will be the payoff of this on the maturity day. So on the maturity day, there's no issue. We know what the price is. It's 1 month before that you need to figure out what the price of the option should be. Okay. Yeah. So now, your questions are not going to be audible to people in the online, right? So I'll have to repeat your question then. But maybe later we'll have a mic floating around. So go ahead. Exercise before the expiry date. Yeah. Yeah. That's right. So that's the difference. There's an early exercise option. All right. Seller or writer of the option. So you should always remember that there are two parties to it, right? One party has to write the option for you to buy the option. So their payoff structure is going to be the opposite. Right? They'll make money. They are betting that the stock price will remain low. You're betting that the stock price will go up. But basically, it's a bet going on. It's one side gains, the other side loses. All right. And then European put option. So it's an option to sell an underlying asset at a specified time for a specified price. So now your payoff becomes, again, the strike price is K. So you can sell for K. You can sell ST for K. So you make money if K is more than ST, right? If your stock price is 0, then you're selling something which is worth 0 for price K. So you're making K amount of money. If your stock price is more than K, then you gain nothing. Then the option is worthless. You throw it in the dustbin, you're done. So this is the picture for, as you can see, the payoff is linear. It's highest at when the stock price is 0, and then it linearly comes down, and then it's kind of worthless after that. If you buy a put, this is a payoff. If you write a put, this is a payoff. Any questions so far?
What do we mean by writing a put?
Write a put meaning you sell a put. Yeah. So you take the opposite position. Okay, now options can be far more sophisticated. So Asian call option is asset prices observed daily for T days, and then the payoff is maximum of average asset price T days on specific times, average asset price minus strike price and 0. This is an Asian call option, right? Now this average need not be daily. You can have bespoke contracts where you specify how you're going to measure the prices. But the standardized ones are the ones which are traded on the exchange. So there's a big Chicago board of option pricing. I forget the name now. Exchange. That kind of where this option pricing trading started. But now options get traded both at NSC and BSC in India. So there you have to have standardized contracts. Then it need not be bespoke. Okay, you can have basket put option. Just giving you some examples. So multiple assets are involved. At the maturity date, average of all the assets is computed, right? And so this is the basket you can purchase at strike price. So if your strike price you can sell at strike price, sorry. So if your strike price is higher, then you gain by by selling it at strike price. Otherwise, you don't. All right. Let's carry on. Huh? I'll just give you some more examples. So this is basket call option. So you have D assets, and you can weigh them in different ways. And again, you have a strike price here. And this positive just means that this is a maximum of 0 and this quantity within the bracket. That's the notation. I mean, these guys have all these contracts usually have, kind of risk mitigation motivation. So if you believe that your costs in your business will go up, if certain commodity goes up or certain stock price that's correlated to it goes up, then having a call option, it pays off when your costs are going up. So it mitigates your risk. Now, it could be that your business doesn't depend upon one asset, but on many assets, right? So then you have this kind of a basket option. So this basket goes up just when you need the money the most. So in that sense, it helps mitigate the risk. It goes down when you're in any case doing well, so you can afford to lose at that time. So it's very well motivated. from economics point of view. So that's another motivation why people hold options. The other is, of course, people speculate. They have a view that the market will go up. So then you buy call options. It's easier to buy a call option than to buy individual assets. It's much cheaper this way. So you can take directional bets easily in this manner. Outperformance call option. Any of these asset goes up, you make money. So your business will suffer if any of the raw material cost goes up, and then this outperformance call option helps you, right? Barrier option. So this is, often these options can be, imagine now options with values of millions of dollars. You're doing that level of trade. So then cost becomes a huge issue. Cost is always an issue. So you're looking at this put option, and then you want to maybe reduce the price in some way, and then you put in these extra features that this put option kicks in only if some other asset, this put option is on asset 1 with S1T price, but if another asset S2, say index, if it goes below a threshold. So this is an indicator function here. This takes value 1 if this event happens, if minimum of S2 Ti observer n time periods goes below B, otherwise it's 0.
Where would this be?
It will reduce the price. So you say to yourself, if the markets go down, that's when you want this benefit, right? Otherwise, if markets are going up.
No, but you're still betting on the other hand. It's not you're guaranteeing a profit on S1 anyways, right?
I mean, it's a regular put option. It will give you if S1T is below K, right? But it won't give you anything if the index is also always remain above B.
Where would this be, say, better than just normal put on?
It'll be cheaper. It'll be cheaper, that's all. You remove some scenarios of payoff. So you just choose those scenarios according to your, needs. You don't mind not making money if this event does not happen.
Transaction costs would be lower.
No, the value of the option will be lower. See, when you pay for the option, you're getting payoff in different scenarios of the world. Now we've reduced that payoff in some scenarios. Right? So you're getting less payoff, you pay less for it. But maybe that's okay for you. So yeah, this is structuring that one can do. Yeah.
The indicator function is they are we take the values A minus S1 T.
Yeah.
So how is that?
Well, because suppose your, the second asset minimum is greater than B. It always remains greater than B. Then this indicator function becomes 0, even if your S1T is less than K. Yeah, so then your payoff becomes 0. If you didn't have this indicator function, payoff would have been K minus S1T, right? Right. So yeah, this reduces the payoff to you in different scenarios. And, one plays around with these things so that the price of the option becomes more acceptable. And this. All right, quantos are, again, you have a call option on asset S1T. So suppose you receive money in rupees on this call option on S1T. Okay, yeah. All right, but then you are interested in the money coming to you in dollars, not in rupees. So S2T captures the exchange rate between dollars and rupees. So I'm just saying that you can have all these kind of multiple asset features in your option. Option need not be on a single asset. It can be on multiple assets. That makes the problem of pricing these things more complicated. All right, and again, all these options will have an associated American feature. Okay, very quickly on interest rate swaps and swaptions. So interest rate swaps are a hugely popular instrument in world markets. Basically, two parties get together and swap cash flows. So one party agrees, so there's some notional amount, say $10 million. One party agrees that it will pay 6% of the notional amount, let's say every 6 months, to another party, right? So every 6 months, 6% of $10 million. That's one party. The other party agrees to pay a variable amount to the first party, and that could be, secured overnight financing rate, SOFR plus 0.5%. So SOFR is just the financing rate, the way the people were lending and borrowing, uh, I think last night in one day before. I don't know the exact details, but it was the exact rate at which people were transacting. It used to be LIBOR. LIBOR had some, I guess, some um, uh, ethical issues to it. There was some kind of gaming going on. So people have shifted to secured overnight financing rate. And then you have then you put plus 0.5% to it. And you compute this in a manner that, both parties are agreeable to this swap. So I mean, again, mathematics goes into coming into the right value here. Should be 0.5%, should be 0.7%. Okay, and this swap could be, for the period of 5 years, 10 years, can be fairly lengthy time period. And SOFR is kind of the lending rate, borrowing and lending that happened last night, but it could also be a longer time horizon. This could be term SOFR, so we're lending for 6 months. So those things one can,
What would
decide based on the contract.
What would be the motivation behind this thing? Like, why would I want to swap my assets with someone else?
Yeah, so why would you want to, yeah, so that's a great question. Why would you want to enter into an interest rate swap? So any answers to this? Yeah, go
If
ahead.
I think, let's say that the average of the SOFR to the about 5% is gonna be more than 6%,
Mhm.
then I'll be the one saying, okay, I'll give you 6% if you give me this.
Right, so
Because then I'll end up making more money than I give to you.
okay, directionally you think that it's a good deal.
Yeah,
Sure,
that by the end of it, you might have given me more.
that's right, that's it. So maybe suppose you expect the interest rates to go up,
Yeah,
right?
I'll be getting more.
Then you'll be getting more money this way, right? Right. Um, Other thing can be, there could be again a risk mitigation motivation that in your business, your cash flow requirements are, what you need to do is maybe give more fixed outflows. You have to pay salaries, etc. So those are fixed, but your income is kind of coming in a variable rate, which depends on the interest rate. Then you can get into a swap where what you receive as a cash flow is fixed and what you pay is variable,
Ah.
right? So this kind of takes care of that risk, or the other way around. So there are a lot of settings where it's very well motivated and hence a huge market. So $580 trillion in 2024, in 2024. Now you can also have options on this. These are called swaptions. So option to enter into a swap anytime in the next 2 years. That would be an example of a swaption. Now, what's the right value of the swaption? So in some sense, you need to have a model of how the interest rates will evolve in this world in the next 5 years or 10 years, whatever the duration of the swap is, right? So you need to come up with that mathematical model. So how does one come up with these things? That's where, I mean, that's where the theory that we discussed becomes useful. But the way the finance people think about this is that they look at all the instruments that already exist. So there already exist bonds which will mature in 10 years' time, in 8 years' time, so on and so forth. And they have prices. And that prices have information of how market expects the world to evolve in future. So you incorporate that information in your pricing, but do it in a structured, systematic way, relying on the no arbitrage principle. So those are kind of issues we'll be talking about in this course. All right, so this is all for the examples. We'll discuss more examples as we go along. But now let me just illustrate the key idea, the no arbitrage principle to price options. And I illustrate this in the simplest of settings. So in the simplest one, so we'll have this one period binomial model, just to keep things very simple. So suppose I have a stock price at $20 right now. And in the simple world, it can only take two values, 22 or 18, 3 months from now, right? And we have an option which expires 3 months later. It's obviously not realistic, right? It's just getting us started on how to think about these things. So what is the value of a European call option with strike price $21 that matures after 3 months, right? And suppose the risk-free rate is 12% per annum. And what that means is it's 3% for 3 months. That's how I'm thinking about this right now. Okay, in this world, and now suppose so $20 becomes either 22 or 18. And suppose you have done, historical analysis of data, and you really, you have your best belief is that there's a 80% chance that stock price will be 22 and 20% chance that it will be 18. So in that world, what should be the price of this option? So anyone? Anyone who's not done option pricing before? So, if you're an insurance kind of person, you just think of this as, okay, what's my expected reward? It's 1 with probability 0.8 and 0 with probability 0.2, right? But maybe I'll discount this at risk-free rate to get the value. That's a risk I'm taking. So it'll be 0.78. And then you say, okay, but it's not, this investment has some risk to it. There's a chance that I'll make $1, but there's also a chance that I'll make nothing. So maybe I shade it up for the risk that I'm taking. That's how the insurance companies work, right? Yeah.
Is the risk-free rate decide, like, given in a problem or?
Yeah, risk-free rate is generally known. Yeah. I mean, right now in the market, if you're going to borrow for 3 months or sell for 3 months, lend for 3 months, there is a rate which is there in the market. Treasury bills is one example, which are risk-free completely. Okay, so then, the way the insurance companies work is, so for life insurance, car insurance, they have an idea of probability distribution of what your losses will look like. I mean, what your, when they sell you the insurance, what the claims will look like. So they have a sense of what the expected loss is, and usually insurance companies are hoping to diversify across many portfolios. So there's enough certainty into it. So they have a pretty good idea of how much the overall expected loss in their portfolio will fluctuate. It's very close to being deterministic, right?
I have a question.
Yeah,
Assuming it would have been an American call option,
right.
would the intrinsic value still be zero for the downside?
I mean, down right is just what the value of the option you have. What's the option worth 3 months later? That will still be zero. If the stock price is 18, then if you hold an option with strike price of $21, it's worthless, right? That will still be true. Okay, so the insurance companies will then kind of shade up with the, how much, I guess, margin they need, how much profits they need to cover their expenses, cover their salaries of their CEOs. So with that, they come up with what the price of the risk should be, right? That's how the game is played. But if you do that in option pricing, you'll get a wrong answer. If you come up with a number in this manner, then somebody can make money off you. That's the big idea. That's the no arbitrage principle. And the way it works is as follows. The big idea is, suppose you have a bottle of ketchup, which is 2 kg bottle of ketchup. It can take, there are 3 scenarios of the world, let's say a year later. This bottle can be worth $10 or $9 or $8, depending on these 3 scenarios. And then you also have these 4 bottles of half kg bottles of ketchup, right? And they also, they also 3 scenarios in the same world. So what should be the price of the 2 kg ketchup bottle?
Should be equal to the
It should, that's the whole point. There's nothing new being done there. It should be 4 times the price of the half kg bottles, ignoring the price of the plastic and all that involved, right? So really, you're not doing some fundamental analysis. You're just saying, you're finding the price of one in terms of the other. So when we do what should be the price of the option, we'll basically ask ourselves, can we create all the payoffs that the option has in all possible scenarios of the world? See, because in all possible scenarios of the world, these 4 ketchup bottles give you the same payoff as this one big ketchup bottle. So because of that, they had better at the same price. Otherwise, there's no moral principle to it. And if this was not the case, suppose this was, coming to, let's say, 180 rupees and this was 200 rupees, what would you do?
I'll buy the short ketchup
You'll
bottle.
just buy as many half kg bottles as you can in the market and package them as 1 kg bottles and sell them, right? Um, right. So because of this reason, because there's money to be made if the prices are not equal. So we'll see that in the option setting, that options are not providing kind of new financial scenarios, new outcomes in different scenarios of the world. Whatever they are providing can be replicated by existing securities, existing stock market and existing risk-free rate, risk-free security. So the price of a portfolio which gives you the same payoff of the option should be price of the option. That's the big idea. Now you say, okay, how can I say the same thing in an extremely complicated manner in a very general mathematical model? That's the kind of purpose of this course, to the first order. All right, so let's do this here. So I'm trying to now create a portfolio which replicates the option payoff. So I'll purchase X stocks and invest Y in risk-free security, right? In scenario 1, my wealth will be 22 times X plus 1.030 times Y. And this I'll set to equal $1. In scenario 2, my wealth will be 18 times X plus 1.03 into Y, and I'll set this equal to 0, right? So now I have two equations and two unknowns, so I can solve them, right? So I'll get that X is 1 by 4 and Y is minus of 4.367. So what that means is that I can purchase 1/4 of a stock. For that, I need $5, and I'll borrow 4.367 units from the market. So I need to invest $6.633. Right? That's the money that goes from my pocket. So I put in $0.633 myself. I borrow $4.367 from the market. I have $5. I purchase 1/4 of a stock. Now, all of this, don't think of in these small numbers. Think that I'm trying to buy maybe 1,000 stocks. So then round off errors are just round off errors. One doesn't worry about that. So I can do all this, right? Now, once I do this, I'll have some liabilities later on, right? Because I borrowed 4.367 amount, I have to pay that back. But on the other hand, I do have an option with me as well, which will have a payoff to me in some scenarios. So let's see how that works. Yeah, so how does that work? So in this scenario, yeah, let's see now. Let me maybe come back to this in a moment. Let me just illustrate this through another manner. Yeah, so I purchased 1/4 of the stock, right? So in this scenario, the 1/4 of the stock is worth how much? It's 5.5. And my liability is worth how much? It must be 4.5, right? 4.367 at 3% will become 4.5. So I'll have exactly $1. I'll pay off my liability now. Because I got this half a stock, 1/4 of a stock with me, right? I'll sell it off. Whatever money I get, so I'll kind of pay off my debt, and I'm actually left with just $1. So the point is, if I've written this option off to somebody, if I've sold this option to someone, then that someone will want $1 from me in this scenario. And by this portfolio, I'll be exactly able to pay that $1 to that person. While in this case, the stock price will be 4.5 and my liability will be 4.5. So it'll be 0. So I've written the option to someone. That person is not going to demand anything from me. I still have a liability of 4.5 that I'll meet from selling the stock, right? So just by, initially I paid 0.633. And from this, I got a payoff of $1 in this scenario and $0 in this scenario. So that should be the price of the option. So let's just discuss this in a moment. All I've basically done is I have spent this much money right now, and I've created a value of $1 in this scenario and $0 in this scenario. That's the achievement. So now, what does that mean? Why is that a right price? So this suggests that the price of the option should be $0.633, right? So suppose the price of the call option in the market was 0.75, right? Somebody was billing, there are people out there who are willing to buy or sell the option for 75 cents. What should I do? Because I know I can create this option for 63 cents. So I should buy low and sell high. That's always a general rule. Right? So I'll just sell the option at 0.75. Okay? So I'll write the option basically.
Yeah.
And I'll take a position in this portfolio, which I mentioned to you, by spending 0.633. So, okay, so then, so I'll, I'll take the position to create this option. So I'll buy 1/4 of a stock for $5, sell the call for $0.75, and borrow 4.367 at risk-free rate. My surplus is 0.117, right? This I keep in my pocket. So I made this money out of nothing right now. And now what happens? In this scenario, my stock, as I mentioned earlier, is 5.5. I have this liability, which is 4.5. And I have this liability because I've written an option. So my overall liability is 0. And this scenario also is 0. So basically, by undergoing these transactions of buying a stock and borrowing some money, I have, by spending $0.633, I've been able to, create a position which exactly pays off the option. So I've sold an option and I exactly pay off my liabilities and I make some money out of nothing. So that's an example of an arbitrage. So the no arbitrage principle says that such an arbitrage cannot exist. So hence the price should be 0.633. I mean, the way it works is that suppose now you say, suppose the price in the market was not 0.75, but suppose it was 0.5. Then what would you do? You'll do the opposite in that case. Yeah, you'll buy this option. It's a cheap deal. And then you'll sell 1/4 of a stock. Right? You just do reverse position. You lend some money at the risk-free rate. And you'll make sure again that way you profit, I guess, 0.133 amount per option and have no liabilities whatsoever. So at every price except for 0.633, there's an arbitrage opportunity. So in this world, there's a unique price, which is implied by the no arbitrage principle, which is 0.633. Is this kind of clear to everybody? That in this world, you don't need to kind of do expected value analysis. You don't need to know probabilities, physical probabilities of how the world will evolve. You can exactly trade in underlying securities and replicate exactly the pair from the option. And that tells you the value of the option. So everybody's with me on this, right? All right. Let's make this a little bit more complicated. So now let's say that we want to do a more refined analysis because you realize that you could trade in between. You can't just trade after 3 months, you can trade in between as well. So let's move in that direction. Let's allow ourselves to trade after 1.5 months. So again, we have a call option with strike price of $21, and now we're using a 2-period model. Interest rate is again 12% per annum, and each time step now is 1.5 months long. And I've kept it, I made the problem a little bit prettier in terms of numbers, but a little bit more complicated mathematically, in the sense I've said that 20 goes to 21 or 19 in 1.5 months, and 21 goes to 22 and 20 1.5 months later. So same thing here. The thing is 21 upon 20 is not the same as 22 upon 21. If I'd kept those proportions right, my calculations would have been much simpler. But then this number would have looked ugly. So to the extent that, that there's enough continuity in the system that small approximations one can live with, one can choose these numbers as well without much loss in accuracy. Yeah, go ahead. You should actually just monitor them, huh? On the chat you made, right? No, but you can monitor and let me know. I see. Okay, this is audio still a problem or? No, I think we had resolved this. Did we discuss how we try to invest in 1/4 of a stock? Well, we discussed in the sense that we solved these equations, right? We had 2 equations and in this case here, we said we purchase X amount of stock and Y amount we invest in risk-free security. Then this is the value of our portfolio if you do this, right? X amount of stock. And this is the value in the above scenario when the stock price goes up. And this is the value when the stock price goes down. Now we set this equal to 1 we set this equal to 0, and then we solve for x and y, and that's how we get this answer. Right? So is this clear? That's how we see that x is equal to 1 by 4. All right. So let's carry forward. So 2-period example. Okay, so you see the tree right here, right? And now again our payoff, now we have 3 scenarios to worry about 3 months later. And our payoff is $1 in this scenario and 0 in both these scenarios. So what's the no arbitrage price for this call option? I mean, the way we made this tree, it's a model of reality, it's an approximation. But the way we made this tree is that every time there are 2 scenarios and we have 2 securities. Every time there are 2 scenarios and two securities, 2 scenarios, 2 securities. And that helps because we can solve for 2 variables with 2 equations. Because you can imagine a more realistic model can be that there should be 3 things here instead of 2, 3 scenarios instead of 2. And then we're in trouble, then we need one more asset. Okay, so what's the price of the call option? So how will you proceed? Anyone? Anyone who's seen this before? How do you proceed now?
Price it at time equals to 1 first and then at t equals.
You ask yourself here that, what will the option be worth if I'm going to get $1 in this scenario and $0 in this scenario, right? My current price is 21. The risk-free rate is going to be 1.5% now. It's half of 3%. So you get a price here. You also figure out how much stock you want to hold at this time. And that again, that's your hedging strategy, right? You at each stage you should know how much stock to hold. Go ahead.
How we get deciding what this one payoff should be?
That's just because the options, first you build a model of the world, which is this guy right here. And now you're trying to price an option, a call option whose strike price is 21. So strike price is 21, when the stock price is 22, the value of the option is $1.
But in the previous case, it was 20 and 20, but then it was still $1.
Because the strike price was still 21, right? So 22 minus 21. That is still true, yeah. All right. So the point is you can find the price at this scenario. You can come here and after lots of effort get the price in this scenario. Can somebody do that effort for me? What would be the option price in this scenario?
What are the probability?
Yeah, so let's say the probability of this is again 0.8, probability here is 0.2. So anyone just kind of, you have to do calculation really fast.
What?
Zero,
Yeah,
right?
zero at that.
Yeah, I mean, you have 2 scenarios of the world. In both scenarios, you get 0. And you have to replicate that.
Would be 0.8.
Purchase 0 stock, borrow 0 money. You'll have 0 in both the scenarios. Right? So this case is easy. This will just be 0. This you have to do a calculation. And once you've done this calculation here, you get some number here. You have 0 here. Then you come back and solve the same problem at this point. So this is like in dynamic programming, your backward recursion, you can kind of go step by step and solve this problem. I'm showing you a small example. People actually used to use these binomial trees for pricing options, and then they'll just chop up the time into 100 steps. So then it's a much longer kind of computation that one needs to do. All right, so let's see what the calculation looks like. So at this point, you'll do a calculation. So what's the calculation again? You're purchasing X stock, right? So you're going to have 22X as before. And plus now you have 1.015 into Y. That's Y is the amount you're lending. So, it's going to give you this much money back. And this has to be equal to $1. 18X plus 1.015Y has to be equal to $0. Now you solve for X. That's an easy calculation. Just subtract this equation from this equation, right? And you get your X is going to be 1 by 4. Is it 18X? No, it's 20X. No, I made a mistake. I made a mistake. Sorry. Yeah. As I keep telling my class, I make mistakes deliberately just to see if you guys are paying attention. So you can see X is going to be 1 by 2. And here I have a proof that this was deliberate. This 1 by 2, yeah. Now you do the calculation of the price, it comes out to be 65 cents, right? And now you can go back and, do the same calculation here. So now in this scenario, you're getting a payoff of 65 cents. In this scenario, you're getting 0 cents. Turns out that you'll have to purchase 0.325 amount of stock for 0.415 cents. And then you'll come up with a portfolio which will exactly give you this payoff. So now with this, you have a strategy. You have what's called a self-replicating portfolio. So what I mean by self-replicating portfolio is I'm going to start with certain amount of money. And as I go along the tree at different scenarios, I'll have some money. I'll change the amount of allocation I have between what I spent on purchasing a stock or selling a stock and borrowing or lending in the risk-free market. But I won't have infusion of money coming from outside, or I won't be taking any money out from the system. So in that sense, it's it should be self-financing portfolio. Not quite sure why I have happened. Self-financing portfolio. So there's no financing happening as you go along, right? Okay, so now how do we do this? So you start with 41.5 cents. You borrow this much money and purchase this much amount of stock, right? At $6.5. So there's some decimals missing here. If stock goes up, the portfolio value at time 1 equals 65 cents. You increase the borrowed amount to 9.85 and use that to change the stock holding from 0.325 to 0.5 in this scenario. If the stock goes down, if you come here, then your portfolio is worth 0. You log out and spend time with your family, right? So that it's clear what you do. But basically, you get a recipe, through this backward induction calculations. Induction is the wrong word, but backward recursive calculations. You get a plan of what you need to do at each step. And with that, starting from here, you get a complete recipe. No matter how the world evolves, in each and every scenario of the world, you know what to do, right? To exactly replicate the portfolio in the end. Exactly replicate the option price in the end.
Just to be sure, this is going to be for discrete amount of.
This is going to be discrete, but the same ideas will extend to the continuous time.
Okay.
That's why we are kind of playing with this. So continuous time, it's harder to see these things. That's why it's good to see them here. Yeah?
Binomial.
This is a strictly binomial model.
Multiple option.
So we'll go towards more general models. So we are just trying to motivate key ideas in the simpler setting, right? And then we'll see how these key ideas show themselves up in a more realistic kind of settings. And also when they don't work. So these are what I'll call later as complete models, where if I give you any option in a binomial tree, you can price any option. Because essentially you're solving 2 variables, 2 equations at every point. So you can do that for any option. But if I had a trinomial tree here, you would not be able to do that. So those are incomplete markets where the certain option payoffs cannot be replicated. So then what do you do? So those are big questions to determine whether the market is complete or not. Yeah.
So we borrowed 6.0 and then we said that increasing borrowed from 6.175. So 6.08 and 6.175, is that just a typo? Did I miss something?
It must have gotten interest, right?
So okay.
Like 1.5%. Yeah. All right, but that's the big idea, that you can kind of, create a portfolio which gives you exactly the same payoff as the option price, and hence the value of the option price should be value of creating that portfolio. That's the big idea. Otherwise, there's money to be made. By buying low and selling high, you can make money. And the option price should be the value of the portfolio, not just at this point, but at every point along this tree. So you're getting the option price all along the tree in this manner. Because all along the tree, price of the option is price of the replicating portfolio starting from there. Right? If I was to have that much amount of money, like 65 cents here, I can construct a portfolio which will exactly replicate the payoff of the option in this scenario. So this broader idea has to be clear, this big idea, that's all, that we know how to price the option. Now what we'll discuss is there's actually a simpler way to do these calculations. So there's a very nice underlying mathematics which makes this pricing much simpler. So I'll talk about that. It won't look so simple in binomial tree setting, but generically the ideas are very useful and simplify a great deal. Okay, do you want to spend maybe 5 minutes at least pricing the option at this point? Put option, right? Right. Let's price the put option at this point. Can you do that for me? In the meantime, I'll just tell the audience also on the web, both YouTube and Zoom, that pretty soon the mathematics, will focus on more conceptual ideas, more probability and all that. So in that sense, this course may be useful to you, that we spend a great deal of time building the underlying mathematical toolkit. That may be something that may be hard for you to read on your own. So this course becomes valuable. So it's clear what you're doing here, right? Yeah, the probabilities are 0.8 and 0.2. It's a very important point about probabilities that I forgot to make. What's the very important point about probabilities that you think that should have been made in this option pricing? It played no role whatsoever in pricing of the option, right? I just came up with two equations and two scenarios, right? Nowhere were the probabilities used. So probabilities play no role whatsoever in pricing the option, right? Probabilities have already played a role in coming up with the tree. The market decided that interest rate is 3%, right? Because it had a sense of how it expects the stock prices to grow, etc. So stock prices and the interest rate have already incorporated the probabilities that the market expects, but they play no role whatsoever in option pricing, except if the probability is zero. Then that line, there's no point trying to, to get the payoff right in that scenario. See, as long as the probability is positive, you want to make sure that you replicate the option payoff exactly. Otherwise, you've not got the exact no arbitrage portfolio. But as soon as it becomes zero, then that scenario doesn't matter. So that's something to also keep in mind. So, zero and non-zero makes all the difference. All right, so you can do this calculation, right? I just wanted to give you some time to absorb this. But the bigger point, I guess, is clear that, probabilities don't matter. Okay, now the point is these options which I showed you, right now the payoff from the option depended on the stock price at the terminal point for the call option as well as for the put option. But you could have more general path dependent payoffs, which depend on the overall path of the stock price. So now here, this is a good example. It's a 3-time period example, multi-time period. So S0 can go up heads or tails, two scenarios. Then the stock price becomes S1H or S1T. And then you can see, so overall, how many scenarios do we have here? There are 3 coin tosses involved, right?
8.
So there are 8 scenarios, right? All of these paths, you'll see these are 8 scenarios, right? And you could have an option whose payoff depends on each of these 8 scenarios. It can be different for different scenarios. So we allow that. So it's like we'll construct a probability space soon corresponding to 3 coin tosses, heads, tails, heads, tails. There are total of 8 outcomes, heads, 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 so on and so forth. Now, random variable on a probability space gives to each outcome a real number. HHH can have one value, HST can have another value. You know what random variable is. Now, option price can be a random variable. It just specifies the payoff you get if you exercise the option in different scenarios. I'm keeping it very general, not just call option payoff or a put option payoff, but very general. And for that level of generality, what's the price of the option? That's the kind of question we want to answer. Is this clear? Okay. All right. So that's where we want to go. A numerical example here is, suppose S0 is 4. The price at each step either doubles or halves. This is just to keep the calculations easy. And interest rate is 25% at each step. Right. I mean, this happens in some countries, but fortunately, we're not there yet. So it's just a toy example. But you can see now you have 4 price here becomes 8 or 2, 16 or 4, 32 or 8, so on and so forth. It becomes 8 here in 3 scenarios, HST, HTH, THH. It becomes 2 in 3 scenarios, TTH, STT, TST. Becomes 0.5 in one scenario and 32 in one scenario, right? So you have these 8 scenarios, and now you can have a price, you can have a part dependent option, such as pricing an Asian option with strike price of 12. Payoff is average of 3 periods. So we just choose that's our payoff. It's average across 3 future periods, minus 12 or 0, whichever is higher. So now you can see that on this path, H, 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 the average stock price is S1H plus S2HH plus S3HHH minus 12 or 0, whichever is higher. And this I'm taking an average, so divide by 3 here. So this turns out to be 8 by 3. On HHT, you can see that this will turn out to be 0. The point is, well, number of points being made here. But one point is that I'm defining these random variables S1, S0, S1, S2, S3. S0 is a random variable, so I'm just translating everything in the probability language. So S0 is a random variable which is constant for all 8 scenarios, right? It takes value 4 in all 8 scenarios. S1 is a random variable which only depends on the first value, first outcome in the coin toss. So it takes 2 values depending on whether the first coin toss is heads or tails. It takes value 8 or 2. S2 is a random variable which depends on the 2 coin tosses. So S2 depends upon more information. S3 depends on yet more information, 3 coin tosses. S1 depends on just a single coin toss. So this idea of information is very natural in finance. As time evolves, we have more and more information. So we'll come back to this when we do continuous time finance. Yeah. Interest rate, I mean, I've not drawn the tree, but the interest rate is 25%. So, you know, I didn't draw it. I mean, right now I've just plotted the value of the option payoff, HHH, HST. When I start pricing it, then interest rate will come up. So if I ask you now how to price this option, see now it won't just be on these nodes anymore. Pricing won't just be on these 3 nodes, backward induction. You will have to look at all the scenarios after 2 time periods. HH, what's the price of the option at that time? HT, what's the price of the option? TH, TT. What's that? V3 is just the value of the option at the final time period. So in that sense, there's no calculation required. So you can just look at the way we define what Asian option is, it tells you what the payoff is. But if you want to find price of the option, if you've seen the scenario HH, then you have to do a calculation. You have to be setting on HH. Now you'll buy some stock, invest in risk-free security in such a manner that on the following scenarios, which is HHT and HHH, you match the value of the option. So you get it?
Yes.
For HH, you'll do the price, HT, TH, TT, then you go back and do for H and T, so on. And you can see this looks nice and simple in 3 time periods, but really when you have n time periods, then you're doing 2 to the power n calculation, that order. right? Because this omega 1, omega 2 through omega n, omega is either h or t, can take 2 to the power n values. So the calculations are exponential in n now because you have a path dependent option. So you got a lot of simplification because your stock price, in some sense, kind of, just depended on the number of heads or number of tails, right? Not on the sequence, for example. All right. So this is the point that I just want to make, that, everything extends in multiple time periods and the calculations become much more complex. Do you find a mistake in what I just said? No. Okay, good. So I'll keep it to myself. I won't tell you.
Yeah.
Okay, all right, good. That's okay. Pricing through risk neutral probabilities. So turns out, and it looks magical, but when we kind of think it through, it kind of makes common sense. It's like the duality theory in optimization. Everything that's interesting, a lot of stuff that's interesting is said through duality theory. Just like as somebody was saying, in mathematics, in many calculation, a lot of interesting things are said through integration by parts. Something new you see. But in this case, it's through duality, but we'll see it more simply here. So, we said the probabilities don't matter, right? But we can choose probabilities to help us as a computational tool. Not because they mean something physically, but because they help in computation. So with that viewpoint, we define risk neutral probabilities. So what are risk neutral probabilities? So probabilities with which asset has the same rate of return as risk-free asset. So risk-free asset has rate of return, I guess in this example, 3%, no matter what the scenario is, right? It's risk-free. Now, so you say to yourself, are there probabilities under which the risky asset also has 3% rate of return, right? It's a fair question to ask. And because of this two scenarios, two variable setting, you can see that you get a unique answer. So 22 into P, that's your payoff you're getting, right? This is the stock price has to give the same rate of return as the risk-free security. So 22 into P plus 18 into 1 minus P. Remember, I'm going back to the stock price, one period stock price. It's at 20. It goes up to either 22 or 18. So 22 with probability P, P is just something I'm looking for, 18 times P. And then the return should be the same return as I get from the stock price if it was giving risk-free rate of return, 3%. So 20 times 1.03. So now I can solve for P, that turns out to be 0.6523, right? And now if I had used these probabilities to price my option, suppose I use these probabilities, then 1 times 0.6523 plus 0 times 1 minus P, because that's a payoff from the option, right? It's 1 with this 0.6523 probability, 0 with the remaining probability, and I discount it with rate 1.03. What do I get? I get exactly 0.63, the option price. So do you see it's a much simpler way to arrive at the same number?
Yeah.
Just find the reasonable probability. And now imagine doing this when you have multiple assets, and now you look for probabilities which make all the assets give you the same rate of return, risk-free rate of return. And then kind of, using those probabilities to find the price, the option, and doing this discounting, that will turn out to be correct. So that's a beautiful result. And in some sense, one just kind of milks this a lot in the world of finance. Again, in very abstract settings. So for put option, you can do the same thing and you'll find the option to be, price to be correct, 67.5 cents. All right, now in the 2 period setting, because I gave you 20, because 21 by 20 was not same as 22 by 21, and 19 by 20 was not same as 18 by 19, these probabilities which are risk neutral, which give you the same 1.5% rate of return in all of these scenarios, will turn out to be different, P1, P2, P3. So you do the calculation, you find those P1, P2, P3, but then the pricing of the option will still remain the same. With probability P1 times P2, so P1 will turn out to be 0.65, P2 will turn out to be 0.6575, P3 I have not calculated. Why didn't I calculate P3? Because it's all zero there, exactly, yeah. So So P of is P1, P2 times 1, everything else is 0.
Is it easy to show that if you use this risk neutral probabilities idea and
Still everything goes through.
yeah, like
Yeah.
it's easy to show that it will always be the same.
Yeah. We'll argue for that. We'll show that. We'll roughly show that right now. It becomes more fancy in general settings. We'll do that maybe in 2 classes. But the point to note is that, first of all, no arbitrage condition guarantees existence of risk neutral probabilities. So why is that the case? So suppose my stock is S0 and it becomes either U0 or D times S0 in the 2 scenarios. And suppose U times S0 is less than D times S0 is less than 1 plus R, the risk-free rate, into S0. Right? What can you say in this world? Actually, let's call it less than or equal to.
You will never buy the stock. You can just sell a lot of DSU.
Hmm?
So you can buy a lot of that and sell it at a risk rate.
Yeah, I mean, somebody is giving you lots of return at a risk-free rate. So you'll just lend at that rate,
Buy.
right? Yeah. And you'll sell the stock.
Buy.
You'll sell the stock. This is the stock right now. There's no option right now. Be the option. So the point is, this guy is giving you 1 plus R, 1 plus R. This guy is giving you U S0, D S0. This is always dominating this guy. So I'll lend at this rate. So I lend S0 amount at this rate. I'll get 1 plus R times S0 at this point, 1 plus R times S0 at this point. I'll
That you lend at DSU, you'll sell that guy, you'll get the money and you
No,
put
no,
it
no.
at S0 instead and you'll get.
see, I'm getting 1 plus R, right? So I'm getting a higher amount here.
Yeah, lending as in you're.
Lending, yeah. So I'm getting, lending, but
Interest rate it gets off.
it's always confusing, yeah. So by lending, I have to pay something, and I'll buy the stock to pay for my lending. I'll sell the stock. I'll sell the stock to pay for my lending.
Why would you sell? Why
Huh?
would you sell the stock?
So I'll get S0 if I sell the stock. By the selling often means shorting the stock, which means that even if you don't have the stock, you go to your broker, and broker is holding somebody else's stock. He sells that stock for you.
Yeah.
And then there's a complex mechanism of margins to make sure that, when the broker finally needs to buy the stock, you don't say, okay, now it's too high, I'm not going to buy it from you. So he make sure that you always make the
Yeah,
payment.
so why would you sell the stock? You would buy the stock and sell the risk free at the risk free rate, right?
No, because the stock is giving you lower return. So it's overvalued.
Yeah.
So you sell high. It's overvalued, so you sell that thing.
No.
Yeah, because it's giving you lower return.
Yeah.
This price is too high. It's higher than what it should be. So you sell high. This price is lower than what it should be. So you buy low.
Right.
Right? So I sell at S0. I get S0 amount of money. I lend that money. Now I'll get S0 to 1 plus R here. I can purchase U times S0 stock and close my position. I still make some money. In this case, I get 1 plus R S0. I can pay DS0 and close my position in the stock. So both the cases I make money out of nothing. There's an arbitrage. So what I need is that 1 plus R S0 should be strictly less than U of S0.
Greater than equal.
No. If it's exactly equal, then also you have arbitrage. Because in one scenario, because D is less than U.
One is 0, one is 0.
Yeah. Even in one scenario, if you're making money, that's still arbitrage. As long as it's with positive probability. Sorry. Right. Is this kind of clear to everybody? Is there anybody left in the audience? Oh, there are people. All right, good. Okay. Now, similarly, you can argue that 1 plus R should be greater than D. Is that clear? What happens if 1 plus R is less than or equal to D?
Opposite argument said.
The opposite argument. Now I'll borrow the money.
Yeah.
Right? And I'll buy the stock. I'll borrow the money and buy the stock. And the stock will have more money than I need to meet my obligations from borrowing. Okay, but because of this, because my 1 plus R is between D and U, that ensures that I can find the value of risk-free probability, that these probabilities exist. They would not have been, because for these to be probabilities, they have to be between 0 and 1. And they are between 0 and 1 because of no arbitrage condition. Very simple thing, right? And again, this simple thing also generalizes. Everything that we do here generalizes. The beauty of all of this is that, the idea of no arbitrage came up by Black and Scholes in 1973 thereabouts. They were chatting with Merton as well, so he was also involved. But they had this kind of a stochastic differential equation, geometric Brownian motion model of the stock price, and risk-free rate was constant. And then they said, suppose at any time I hold a call option and I hold just the right amount of stock price so that for the next delta t time unit, the risk of the portfolio that I'm having, call option and right amount of stock price, the risk is exactly canceling out because I know the gradients of these things. So because for the delta t time unit, the risk is canceling out, the return from this should be delta, R times delta t, risk-free rate times delta t. That's how they use the no arbitrage argument. Just this for delta t, you work it out, take delta t to 0, you get a partial differential equation that the option price should satisfy. That's called the Black-Scholes partial differential equation. So this led to the birth of kind of option pricing, but all these clever ways of seeing things came later. So binomial trees, there was, I think, Cox, Ingersoll, Ross model in 1978 or so. So then they showed binomial trees, how pricing gets done there. And then Harrison and Krebs, in their famous paper in 1980 thereabouts, came up with this duality theory of pricing. And they came up with this risk neutral probability measure. They use change of measure ideas. I'll talk about that much later. But what's nice about what they write is because they're not professional mathematicians. These are people who do research in the world of finance and know the mathematics that they need to know. They say we are on the kind of threshold of our knowledge of probability and stochastic calculus, but it seems to us that it was designed precisely for pricing options and financial derivatives. Because every tool they needed was exactly the big tool that existed in stochastic differential equation. Like Gersdorff's theorem that we'll talk about, Martingale representation theorem. These are completely non-trivial tools and they fit in like a jigsaw puzzle in this setting. So it's just beautiful how it all came together. Almost like, unexpectedly. I mean, completely unexpectedly. All right. So the big idea that we're going to do, so this is the big idea, and I'll say this like a few hundred times during this course maybe. So under risk neutral probabilities, so we found the risk neutral probabilities now, right? That's what we did. Yeah. And the good thing is under those probabilities that the stock prices increase on an average at the same rate as risk-free securities, right? So then if I construct a portfolio combining these two, at what rate will that increase? See, stock price is increasing at 3% rate on average. Risk-free security is increasing at 3% rate. You have certain amount of stock price, certain amount of risk-free security, that portfolio, at what rate will it increase? It's a linear combination. That will also increase at 3% rate. If I discount that by 3%, discount that by 1.03, that will on an average not change. Yeah. So replicating portfolios on average will not change. And that's called a martingale process. So we'll study this. We'll see how martingales come in. Martingales are processes which at any time, at any state, do not on an average do not change. In expectation, they're the same. So our replicating portfolio process in this new probability that we found out has this property that on an average it does not change. But what's nice is that we've discussed in this two variable, scenario process that we can kind of replicate any option price. We can create a that's why we call it self-replicating portfolio, because we're replicating the option. But self-replicating or self-financing portfolio, we can construct such portfolios which exactly replicate the option payoff. We can do that, right, by solving this 2x2 equations. In every scenario, we can do this. So that means there exists a self-replicating portfolio process which exactly matches the option. Hence, the value of the self-replicating process is the value of the option price, right? That's how we decided what the option price should be. It's the value of the process, otherwise there's arbitrage. So option price process when discounted is also a martingale. So that simple fact you have to observe. that under the new probabilities, this option price process when discounted is a martingale, and martingale tells you certain nice properties. We'll talk about that in a moment. In particular, the expected value of martingale at some time later is same as the expected value at any time earlier. And that basically tells us the price of the option. We'll see that in a moment. All right. So discounted value of any option whose payoff can be replicated by a self-replicating portfolio equals the expectation of its discounted payoff under the risk neutral probabilities. Yeah, I don't know what I'm saying here. Yeah, I'm just saying that the value of the option is same as the value of the replicating portfolio. Okay, so the fundamental theorem, therefore, in option pricing is that the no arbitrage condition implies the existence of equivalent martingale probability, and I'm going to call it probability measure, that's the standard language, equivalent martingale probability measure P tilde, under which discounted asset prices are martingales. And this is the abbreviation I'm going to use.
But the explanation is
Yeah. Yeah. In this binomial setting.
in the binomial.
In the binomial setting, yeah. Yeah, it becomes more complicated in more general setting. Okay, so no arbitrage condition implies that such probabilities exist and under which these guys are martingales, discounted. So SNs are increasing at the risk-free rate, and when I discount them, I get processes which are not increasing on average. And hence the attainable option price process, attainable meaning all these options that can be attained by a self-replicating portfolio. In the binomial setting, every option can be attained. So all those things, all the option prices are also, when discounted, are martingales. So that's a fundamental theorem of option pricing. That's one aspect of it.
Go back about what there. Then is the asset price.
SN is the asset price.
PN is the attainable option.
Yeah.
At the time.
That's right. That's good. So SN is the option price. How are we doing on time, by the way? My God. You guys are a fun audience.
Yeah, I think the first 20 minutes or something went away in logistics, right?
So my watch is saying 11:42, right?
Yeah, 40 in the next section starts.
Huh?
At 11:40, the lecture ends. 11:50, the next
So
one.
it's from 10:20, isn't it?
10.
Oh, I thought the class starts at 10:20. That's why I was kind of very relaxed at that time. Oh my God, I see. So let's compromise. Let's stay on till 10:45, till 11:45. Then you can run really fast. Okay, sorry about this. Yeah, sorry about everybody. I didn't mean to delay you this much. I just wanted to delay you a little bit. All right. Yes. All this back and forth in finance. Okay. So, and these are called equivalent martingale measures. So I'll talk about this later. Right now, just take it for granted that this is an added term that we've added to probability measure. Equivalent just means that the physical probability measure gives positive probabilities to some scenarios, zero probability to other scenarios, and this probability measure also does the same. It's not like this is giving positive probability to scenarios where you earlier gave zero probability. So that confusion is not happening. This term is kind of, it's important in continuous probability. I mean, to say that two measures agree on the same, give positive probability to the same set of outcomes is an important thing to say. So that's why the word equivalent is important. All right, what else is there? Well, you know what?
Do you know what unique? It's always.
No, so the point was, what happened to these my slides? Sorry. Where do all my other slides go? That's where they are. Yeah, this is unique in this two scenarios, two variable setting. Yeah, otherwise it's not always unique. Yeah. Okay, let me just say this part before you go. Just take this slide with you. It's a little fast. I mean, I think I made a mistake. I'm going to put this slides above those two slides. But nonetheless, let me say this to you. There's enough meat in here for you to go back. So if there exists an equivalent martingale probability measure P tilde, then arbitrage is no longer feasible. So this is another result that's extremely important, that if there is a probability measure under which all the stock prices when discounted are martingales, then you cannot have an arbitrage in the system. So this is important because in finance, people often just say, because we don't believe there should be arbitrage in the system. They just assume that such a probability measure exists and then use the data to fit that probability measure.
No, but what if, why do we want there to be still equivalent martingale probability?
Well, so we're saying if there exists a martingale probability measure where all the stocks are martingale.
Compared to the ortho probability.
Yeah, yeah.
Okay.
So why is that the case? Just look at this very quickly. So consider a portfolio process x1, x2, xn. So portfolio's value is x1, then x2, then xn. Suppose x0 is 0 and xn is non-negative in some scenario and strictly positive with positive probability. So this is an example of arbitrage, right? You give 0 in the beginning and you make money with some probability later with no risk. So can such a thing exist? If such a thing existed, its expected value will be positive. But because we have a martingale, x0 should be equal to expected value of xn. So this we'll cover later, but you kind of expect this to be true. So because these two have to be equal, so that means this expectation should be 0. So it can't be positive, so they can't be arbitrage. So that's a very simple reason that equivalent martingale measure actually precludes having an arbitrage. All right, guys, now you should run to your next classes. Thank you. Yeah, next time.